Hello and welcome to IUL with Jarrell. Today we're going to talk about what is an IUL and how does the cash grow within a policy. So let's start off with what is an IUL. An IUL is an index universal life insurance. The way an index universal life insurance policy works is traditionally, if our goal is cash accumulation, we want to get the absolute smallest amount of life insurance the IRS physically forces us to get based on their 7702 guidelines. So we want less money going to the insurance companies and more money going to our pockets. Now, as that money goes in, it's very important to understand how it actually grows. Now, within these contracts, they actually use something referred to as options. Now, as a recap, what an option is let's say that you have a $100,000 home and you want to sell this house, but you don't want to sell it now, you want to sell it next year. You can sell the option to buy this home for 5% or $5,000. Now, if that house goes up in value to $120,000, you would have to sell that home for $100,000. So therefore, the opportunity cost would be $15,000 because either way, the seller of the options gets to keep the $5,000. Now let's say the opposite happens. The market goes down to $80,000. Would you purchase the house for $100,000 when it's only worth $80,000? No, of course not. So you would elect not to purchase that. In that case, we would lose the $5,000 that we put down. So therefore, the option seller would gain $5,000. And that's options in a nutshell. So how does it pertain to a life insurance contract? Well, these insurance companies are really good at making money. So what they do is they take the $100,000 and they put it in their general fund portfolio. And this is where they offer the fixed rate. So let's say that the fixed rate is 3%. What this means is you'll earn $3,000 no matter what happens to the economy. So if the economy goes up 10%, you get 3%. If the economy goes down 10%, you get 3%. This is what's referred to as their fixed rate. Now, what they'll do is they'll say, hey, Brian, rather than take the 3% fixed rate, would you like to use it as an options budget? Now, we take this $3,000 and we participate in the options. Let's say those options give me a 10% cap. Now, if the S&P 500 was to do 10% or better, I would get credited $10,000 instead of $3,000. However, let's say that the market goes negative 10%. Now, zero's the hero. We can't lose any money because our money is not in the index. It's tied to the index. So if the market was to crash 10%, all we would lose was the $3,000 they were going to give us anyways. So therefore, as you can see, we don't lose any of our actual principal. All we lose was the money they were going to give us anyways. So it's very important to understand how this works. Now, there are different crediting allocations and you can elect to take the fixed rate. Let's say, for example, you feel like the economy is not going to do good next year. Well, what you could do is you could tell the insurance company, hey, rather than taking my money to go purchase options, just give me the fixed rate. In this case, you would receive the 3%. Now, there's different crediting allocations too, depending on the company. For example, there's a really fun one out there referred to as the Uncapped Index. What this does is it completely removes the cap. So to do this, they do have something referred to as a spread. Let's say that spread is 10%. What this means is if the market was to do 30%, they would take their 10% spread, you would be credited 20%. If we were in the traditional one and we only had a 10% cap, we would only get 10. So where this one really doesn't work out very well is what happens if the economy was to do 15%, yet they subtract their 10% spread, now you only get 5%. So it's not always going to be the best decision because if we would have stayed in the standard S&P with the 10% cap, we would have actually got the full 10%. Now, if the market was to do 5 and then take a 10% spread, normally this would be a -5. But remember, zero's the hero. You don't actually lose. You would just lose your options budget. So therefore, your principal is protected. So when would we use a strategy similar to this? So traditionally, it's used as a recovery index. So for example, let's say in the year when COVID came out in March 2020, the market actually crashed 60% almost overnight. Now, when you look back, if you had a policy, remember zero's the hero, so that year you would have lost absolutely nothing. The only thing your account would have went backward were cost of insurance and fees. There would have been actually no participation in the market volatility. Now, after that, what happened? In March 2021, the market actually recovered 66%. Now, a lot of this is because of America did unfortunately print off a bunch of money and throw it into circulation. So that's kind of why we're dealing with the inflation rates that we are here in 2023. But at this time, they had a 5% threshold on that index. So what would have happened is during the recovery, you would have got 66 minus 5. Therefore, you would have got 61% all in one single year. Now, this is an actual physical statement from an actual client. You can see here that it was during the segment of 3/15/2021. In this case, the client had $872,000 of cash value. They were credited 61.33% on net after fees. So you'll see here, even though they had 872,000, there were fees and stuff involved. So they earned 61% of 852,000, which means $535,313.34 was added to their account. So once that segment was added to their account, their new cash value is actually worth almost $1.4 million. Now, am I saying this is going to happen? No. The stars, the moon, everything aligned for this to happen, but it does show some of the potential that you could actually get into an index universal life. So it's very important to understand what company you go with and what different crediting allocations they choose from. It's also important to make sure that you're taking a look at the different crediting allocations each year, because if one year you get 10% and the next you get 0, you're now averaging 5%. Versus if you were to take the 10% one year and you were to, let's say, take the fixed the next year because you anticipated a bad year, now you're averaging 6.5%. Well, one of these will underperform the illustration, while this one will outperform the illustration. So with that being said, I hope this brings a little bit more clarity on how the money grows and how 0 is the hero. For more information like this, go ahead and like and subscribe for future videos.